Welcome to the chapter on long-term assets. The objectives we're going to cover in this chapter involve identifying the major types of property, plant, and equipment, identifying the major types of intangible assets, talking about the accounting treatment of expenditures after acquisition. Then we'll calculate the depreciation of property, plant, and equipment and calculate the amortization of intangible assets. We'll account for disposing long-term assets and then talk about the link regarding the return on assets, the profit margin, and the asset turnover, and then lastly talk about impairment situations. So Krispy Kreme cannot make donuts without its manufacturing facilities and the equipment in those facilities. In contrast, it's not physical assets, but copyrights on its computer software that gives Google the ability to generate billions of dollars in revenues each year. Now, both of these types of revenue-producing assets are considered long-term assets. We classify long-term assets into two categories. One, tangible assets. Those are assets that include land improvements, building equipment, and natural resources. They have a physical substance. The intangible assets include patents, trademarks, copyrights, franchises, and goodwill. We distinguish these assets from property, plant, and equipment by their lack of physical substance. Now, the evidence of their existence often is based on a legal contract. Long-term assets often represent a significant portion of the total assets of a company. This slide presents a breakdown of the total assets for Darden's Restaurants, a publicly traded company that owns and operates various restaurant chains like Olive Garden, Longhorn Steakhouse, and Bahama Breeze. Note that current assets represent only 28% of total assets, but long-term assets make up the remaining 72%. Accounting for long-term assets, both tangible and intangible, is important, and that's the focus of what we're going to talk about in this chapter. Now, in this section, we consider the first issue in accounting for long-term assets, which is to identify them and measure their costs. So that's the first item we are going to handle, is identifying the major types of property, plant, and equipment. The property, plant, and equipment category consists of land improvements, buildings, equipment, and natural resources. Now, we record a long-term asset at its cost plus all the expenditures necessary to get the asset ready for use. So the initial cost of a long-term asset might be more than just its purchase price. It will also include any additional amounts the company paid to bring the asset to its desired condition and location for use. So that might be altering the asset for specific purposes of the company and to get it to the location it needs to be in. We use the term capitalized to describe recording expenditures as an asset. The land account represents land a company is using in its operations. We capitalize to land all expenditures necessary to get the land ready for its intended use. So these types of costs include the purchase price of the land plus closing costs, such as fees for attorneys, real estate agent commissions, title searches, recording fees, and if the property is subject to back taxes or other obligations, we also include those amounts. Any additional expenditures like clearing the land, filling it, leveling it, or removing old buildings to prepare the land for its intended use also become part of that land's capitalized cost. Any cash received from selling salvage materials from old buildings torn down help reduce the cost of that land account. So using the guideline of cost plus all expenditures necessary to get an asset ready for use, Olive Garden would record the cost of the land at $590,000. Now the way that is determined is by the purchase price, the commissions, any back property taxes, title insurance, which is a cost of purchasing the land, cost of removing the existing building, minus any salvaged materials that we received money from the existing building, plus the cost of leveling the land, give us a total asset on land of $590,000. Let's look at a problem here. So the Italian Pizza Company purchased land as a factory site for $90,000. Prior to construction of the new building, the land had to be cleared of trees and brush. The construction costs incurred during the first year are listed below. So we've got here the clearing land of $5,000, the sale of firewood to a worker of $400, architect fees for the new building $30,000, title investigation $3,500, property taxes for the first year of $3,000, and the building construction costs of $400,000. We're going to determine the amounts that the company should record in the land and the new building accounts. So, as you see here, the purchase price of the land $90,000, the land clearing costs of $5,000, the sale of firewood to a worker we would subtract $400. The architect fees for the new building would go under the building account. The legal title for the land would go under the land account. The building construction costs of $400,000 would go under the building account. So far we would have, for purposes of the land account, a total of $98,100, and for the building it would be $430,000. Now it's important to note that the property taxes on the land are going to be recorded as a property tax expense for the first year. They are not back property taxes, so they won't be capitalized. They're an expense in the current period. Beyond the cost of the land, companies likely will spend additional amounts to improve the land by adding a parking lot, sidewalks, driveways, landscaping, lighting systems, fences, sprinklers, and similar additions. These are land improvements. Because land improvements have limited useful lives, parking lots do eventually wear out, and land has an unlimited useful life, we record land improvements separately from the land itself. Buildings include administrative offices, retail stores, manufacturing facilities, and storage warehouses. The cost of acquiring a building usually includes realtor commissions and legal fees in addition to the purchase price. The new owner sometimes needs to remodel or otherwise modify the building to suit its needs. So these additional costs are part of the building's acquisition cost. Now, unique accounting issues arise when a firm constructs a building rather than purchases it. So the cost of construction includes architect fees, material cost, and construction labor. But new building construction also can include manager supervision, overhead, which might be costs indirectly related to the construction, and interest cost incurred during the construction. Equipment's a broad term that includes machinery used in manufacturing, computers and other office equipment, vehicles, furniture, and fixtures. Now, the cost of equipment is the actual purchase price plus all costs necessary to prepare the asset for use. These can be a variety of costs, which would include sales tax, shipping, delivery, insurance, assembly, installation, testing, and maybe even legal fees to help establish title. But what about the recurring costs related to equipment, such as annual property insurance and property taxes on vehicles? Rather than including recurring costs as part of the cost of the equipment, we do expense them as we incur them. Let's assume that Olive Garden purchases a new restaurant equipment for $82,000 plus $6,500 in sales tax, and it pays a freight company $800 to transport the equipment and $200 of shipping insurance. The firm pays $1,600 for 1 year of liability insurance on the equipment in advance. The equipment was also installed at an additional cost of $1,500. Now this slide shows the calculation of the amount at which Olive Garden would record the cost of the equipment. So Olive Garden should record the equipment at a total cost of $91,000. With the exception of the $1,600 annual insurance on the equipment, each of these expenditures described was necessary to bring the equipment to its condition and location for use. So Olive Garden will report the $1,600 for 1 year of liability insurance as prepaid insurance, and then it would allocate the $1,600 to insurance expense over the first year of that insurance coverage. Sometimes companies purchase more than one asset at a time for one purchase price. This is commonly known as a basket purchase. So let's say, for example, Olive Garden purchases land, building, and equipment together for $900,000. We need to record the land, the building, and equipment in separate accounts, but how much do we record in the separate accounts for the land, the building, and the equipment? Now, the simple answer is we allocate the total purchase price based on the estimated fair market values of each of those individual assets. So estimated fair values are estimates of what the separate assets are worth. So Olive Garden's total purchase of $900,000 would be allocated to the separate accounts for land, building, and equipment based on their relative fair values as shown on this slide. Let's look at an exercise here. Red Rock Bakery purchases land, building, and equipment for a single purchase price of $600,000. However, the estimated fair values of the land, building, and equipment are $175,000, $455,000, and $70,000 respectively, for a total estimated fair value of $700,000. So our job's to determine the amounts Red Rock should record in the separate accounts for the land, building, and equipment. So as you see here, we're going to allocate the estimated fair values based on a percentage of the total of the purchase price of $600,000. So the land would then be recorded at $150,000. The building would be 65% of the total purchase price, or $390,000, and the equipment would be 10%, or $60,000. So the new recorded amounts would total the $600,000, but they would be allocated based on the percentages. Let's look at a question here. A company makes a basket purchase of land, buildings, and equipment with estimated fair values of $70,000, $150,000, and $30,000 respectively. The purchase price is $210,000. How much should be recorded to the land account? So if land is $70,000 out of the entire $250,000, then we would take the 70 by 250 to come up with a percentage. So that 70 divided by 250 would be 28% of the total. Since the purchase price is $210,000, 28% of $210,000 would be $58,800. Now, in addition to land, buildings, and equipment, some companies depend heavily on natural resources such as oil, natural gas, timber, and even salt. We distinguish natural resources from other property, plant, and equipment by the fact that we can physically use up or deplete natural resources. So remember here, tangible assets such as land improvements, buildings, equipment, and natural resources all get recorded at cost plus all the costs necessary to get the asset ready for its intended use. Next, we're going to identify the major types of intangible assets. Now, the other major category of long-term assets, which are intangible assets, have no physical substance. Assets in this category include patents, trademarks, copyrights, franchises, and goodwill. Now, despite their lack of physical substance, intangible assets can be very valuable. One of the most valuable intangible assets for many companies is their trademark or brand. Companies acquire intangible assets in two ways. They purchase them or they develop them internally. Purchased intangible assets are recorded at their original cost plus all other costs like legal fees necessary to get the asset ready for use. For internally developed intangible assets, most of those costs get expensed right away on the income statement as they are incurred. Here you see a slide where it publishes an annual list of the 100 most valuable brands. So this slide summarizes the 10 most valuable brands. As you see, the Apple brand has an estimated value of $118.9 billion. Despite this value, Apple reports total intangible assets on its balance sheet at less than $10 billion. We'll see later why many intangible assets are not recorded in the balance sheet at their estimated values, but are recorded at what was purchased for those assets. Now, a patent is an exclusive right to manufacture a product or to use a process. The U.S. Patent and Trademark Office grants this right for a period of 20 years. When a firm purchases a patent, it records the patent as an intangible asset at its purchase price plus other costs such as legal and filing fees to secure the patent. But in contrast, when a company develops a patent internally, it expenses the research and development costs as it incurs them, and they flow on the income statement. A firm will record in the patent asset account the legal and filing fees incurred to secure the patent, even if it developed the patent item or process internally. The costs of successfully defending a patent, including attorney fees, also get added to the patent account. A copyright's an exclusive right of protection given to the U.S. Copyright Office to the creator of a published work such as a song, a film, a painting, a photograph, book, or computer software. Copyrights are protected by law and give the creator and his or her heirs the exclusive right to reproduce and sell the artistic or published work for the life of the creator plus 70 years. A copyright also allows the copyright holder to pursue legal action against anyone who attempts to infringe on this copyright. Accounting for the cost of copyrights is virtually identical to that of patents. Now, a trademark is a word or slogan or a symbol that distinctively identifies a company, product, or service. The firm can register its trademark with the U.S. Patent and Trademark Office to protect it from use by others for a period of 10 years. The registration can be renewed for an indefinite number of 10-year periods, so a trademark is an example of an intangible asset whose useful life can be indefinite. Firms often acquire trademarks through acquisitions, so Hewlett-Packard acquired all the outstanding stock of Compaq Computer Corp. For $24 billion, of which $1.4 billion of it was assigned to the Compaq trademark. The estimated value of the trademark is not recorded in the trademarks account. Instead, only the legal registration and design fees are recorded. The advertising costs that help create value for the trademark get recorded as an advertising expense. Franchises are local outlets that pay for the exclusive right to use the franchisor company's name and to sell its product within a specified geographical area. Many popular retail businesses such as restaurants, auto dealerships, and hotels are set up as franchises. To record the cost of a franchise, the franchisee records the initial fee as an intangible asset. Additional periodic payments to the franchisor usually are for services the franchisor provides on a continuing basis, and the franchisee will expense them as incurred. Goodwill often is the largest and most unique intangible asset in the balance sheet. It's recorded only when one company acquires another company. Goodwill is recorded by the acquiring company for the amount that the purchase price exceeds the fair value of the acquired company's identifiable net assets. This slide summarizes the calculation of goodwill, which is $10 million that Allied Food would report in its balance sheet. Most companies create goodwill to some extent through advertising and training and other efforts. However, as it does for other internally generated intangibles, companies expense costs incurred in the internal generation of goodwill. So as you see in this slide, when one company purchases another company, that is how goodwill becomes an asset on someone's balance sheet. So as you see here, a company acquires another for $36 million. The following information is known. Fair value of the identifiable assets is $50 million. Fair value of the identifiable liabilities is $24 million. How much will the acquiring company record as goodwill? Well, the 50 in assets minus the liabilities of 24 show the fair value of assets, net assets of 26. But since the company's purchasing the acquired company for 36, the remainder, or 10, will be considered goodwill. A key point to remember here is intangibles include patents, they include copyrights, they include trademarks, franchises, and goodwill. Now let's look at a exercise 7.7 in the back of your chapter. Satellite Systems modified its Model Z2 satellite to incorporate a new communication device. The company made the following expenditures. So you see basic research to develop the technology, $3.9 million, engineering design work, $1,180,000, development of a prototype device, $590,000, testing and modification, $390,000, legal fees for patent application, $79,000, legal fees for successful defense, $39,000, for a total of $6,178,000. Now, during your year-end review of the accounts related to intangibles, you discover the company capitalized all of these costs as a patent asset. Management contends that the device represents an improvement of the existing communication systems of the satellite and therefore should be capitalized. which of the above costs should the satellite system capitalize to the patent account? Which of the above costs should satellite systems report as research and development expense on the income statement? And what are the basic criteria for determining if you capitalize or if you expense? So as far as the cost to capitalize, legal fees for the patent and for defense would be capitalized. Those are the only items that get capitalized for an internally generated patent. So that would total $118,000. The items that would be put on the income statement would include the rest: the research, the engineering design work, the development of a prototype device, and the testing and modification for $6,060,000 for R&D as an expense on the income statement in the current period. Purchased intangible assets get capitalized. Internally developed intangible assets get expensed apart from legal fees.